we are neutral equities right now in a portfolio context. It reflects stretched valuations. It reflects heightened political risk ahead of U.S. elections. And, of course, there's this seasonal factor you mentioned as well. Over the medium term, we are positive equities, and certainly the long term as well, in a low interest rate environment. But right here, right now, I think the near-term risks are such that a neutral positioning is probably the more appropriate.
Okay. On a sector basis, though, despite all this talk of a tech sector rotation and a leadership leading its charge, it sounds like you like Chinese tech still, which has had a good run. What's the case?
Well, absolutely. Again, at a global level, we were getting a little bit concerned about the run-up in valuations and the increasing likelihood of a correction. I think we're seeing that right now. But at a more granular level, particularly in China, we feel there's further upside, further opportunity. In terms of valuations, it's interesting on a price-to-book basis, for example, China Tech is trading at half the level that its U.S. counterparts are. And we think that there is an opportunity in the months and quarters ahead for that valuation premium to narrow somewhat. The reality is that China's domestic market is vast. And whilst its international opportunities and ambitions are possibly facing headwinds right now, nevertheless, at the domestic level, in all the main areas that we are positive on, artificial intelligence, electric vehicles, 5G, data storage in the cloud, these areas are all likely to expand by between 15 and 20% a year over the next 3 or 4 years. And in our minds, this leads to an ample opportunity in these so-called new economy sectors.